This is your first lesson about the stock market. If you don't know where to start and you want to learn how to trade, invest, learn about dividends, covered calls, and any of those advanced strategies, you have come to the right place and this is where you need to be. The first thing that you need to know and understand is, what is a stock? If you're going to invest in something and be buying and selling something, you need to know what it is first. So that's why this is the most important starting point for your financial education and your financial literacy. So I'm going to jump right into it. I'm going to move quickly, so feel free to slow the video down or pause it if you need to. A stock is essentially a piece of a company. It is a piece of a pie. So, for example, if I have 4 slices of pizza, 1, 2, 3, 4, and I give you a slice. Let's say I give you slice number 4, right? So I have my pizza pie and I give you 1 slice. If the pizza pie is worth $4, that means each slice is worth $1, right? Because every piece, right? 4 pieces make up $4, right? So each piece is worth $1, right? We're gonna keep things very simple. What happens? So this is cheese right here, and this is tomato right here. Obviously, because tomatoes have T's on them. But what happens if the price of cheese and tomatoes increases? Let's say it's a magic pizza slice that never expires, it never gets old, and now the price of cheese, tomatoes, and dough suddenly increases. There's a shortage in the world, and now cheese is super valuable, tomatoes is super valuable, and let's say dough is super valuable. What's going to happen to the price of your pizza slice? What's going to happen to the value of pizza? This is going to do what? It's going to increase because a lot of people might want pizza now and there's not enough to go around. So your pizza slice becomes that much more valuable. So now, let's say the price of these things have increased so much that now a pizza is worth $12. So that means your individual slice, 1, 2, 3, 4, your individual slice is now worth $3. So if your friend gave it to you when it was at $1 and then you sold it when it was $3, you essentially let time pass and you made money when the price and the value increased. Why did the value increase? Because supply was low. And demand was high, right? So there's not a lot of pizza in the world and a lot of people want it, so the price is going to increase, right? Supply and demand essentially is the driving force of the entire market. Essentially, it's the same thing that happens with stocks, except for having 4 slices. It's more like having millions and millions and millions of individual little slices. These little slices are called shares. I'm sure you've heard the term if you've done any kind of looking into stocks, or even just heard people casually talking about it. So instead of 4 slices, maybe you have 10 million slices, right? So let's say this company is Apple, and you want to buy 1 share of Apple. 1 share of Apple is, let's say, $100, right? I think they're trading right now at like 175, but just for the sake of argument, we're gonna say 1 share of Apple is $100. So you go on your broker, you go on your phone, you buy 1 share, you spend $100, and now let's say Apple announces the iPhone 16, right? It's gonna come out this holiday season, and it has revolutionary features. It's gonna be groundbreaking, and they anticipate that they're gonna make a lot of money. what is going to happen to Apple's stock price? It's going to go up, right? Because with that news, there's going to be more demand for Apple stock. People are going to be holding their Apple shares because now they know the new iPhone's coming out, so they don't want to get rid of their shares, right? So demand increases, and since more people are buying those shares, there are less shares available in circulation. So supply decreases, supply goes down, and that means value goes up. So now you bought in at one share at 100. Maybe after a couple months, Apple stock is trading now at, let's say 125, right? So off of the announcement of the iPhone 16 and time passed for the news to circulate, hype to be generated, people to get in and buy more shares and not sell their shares and hold on to those shares, and people demanding and wanting more of, Apple shares because they know the price is going to go up. So demand is high, supply is low, the value increases, and this is done through announcements and news and hype and more revenue coming in for the company. So now your one share has increased to $125 and you have profited $25, right? So you bought it for 100 and you profited 25. So yeah, essentially this is the basic of the stock market. This is the first premise that is important to understand. Obviously it gets a lot more technical and complicated, but I think this is a great starting point. So I wanted to keep this video short and simple. So if you enjoyed it, please give it a thumbs up and consider subscribing to the channel for more concise breakdowns like this. Thank you guys so much for watching, and please stick around for lesson number 2, where I will continue off of this information.